You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
Hello, Jim.
We said something right off the top a few weeks ago about if a market is too clear, too obvious, well, then it's probably too obvious that you're not going to make much of a profit on it if you're just jumping in. Is that still the case today? If it's too clear, it's too late.
I think that's really true. If you look at the Dow, that everybody knows it's in a bull trend, and a lot of people feel it's going to keep on going, and it may for a while, but we're certainly at a much riskier level at the levels we are now than where they were even a year ago, and certainly 2 or 3. And so people that would never even give it a second look now feel that they have to be in the markets, and so they're accepting a lot of risk because it's much clearer now that it's in an uptrend and certain reasons why, and so the price is higher too. So if you get in earlier, you accept more risk. If you get in later, you accept more risk of a different kind. That's just what it is.
Now, this risk is that you've accidentally bought in at the top of the market, and it's going to take a big slide.
Right, and even if it goes substantially higher, at some point when there is a big correction, it can erase all of your gains in a pretty short order. And you look at the mining stocks, we've kind of been focusing on that, and some of these stocks have come up 150% off the lows. They were the very depressed prices, but there are some nuggets out there, no pun intended, or actually maybe pun intended, but they're up 30 or 40%, and yet they're very good stories that just have been overlooked by the market. We haven't gotten to the point yet where a rising tide lifts all boats. And so I feel that it's worth people's time to go and look for those nuggets. It may be a position you have that has really suffered a lot, and you go back and look at it, and you decide, well, hey, I want to stay with this position and maybe add to it. And I'll give you an example. First of just the first part of the story is something that I should not have done, but I did. I allowed a position, not a huge position, but a position in a mining stock in a Colombian gold producer to lose 80% of its value over the last couple of years. And I really think I kind of lost track and didn't pay too much attention of it. And so I went back to it, and of course was mortified that I was down that much. Started researching a couple of days ago, actually a couple of weeks ago. Put in a stink bid below where it had been trading, and then did some more research over the last few days and realized that I really wanted to hold that stock, that at this price it represented, in my view, a very good price point to be adding. So I got out of the stink bid. I just canceled it, and I went in and bought at a limit price today, about a penny above where it was trading, and I quadrupled my position for a fairly small dollar addition. And now if the market goes up even moderately, I should be able to get back to break even before too long. If I had felt, and I actually did this last week, that I had a stock that had been down a lot and made a mistake and no longer it didn't make sense, I would sell it. And that's what I did last week to a particular stock and put into the one that I feel has much potential, and I'm already up about 20 or 30% on that. So it gets easier each time you do it. It used to be extremely difficult for me to do something like that, but I just want to tell people who are listening that if they look at these stocks, first of all, it's good not to let yourself drop that much. If you put a stop loss in, you're much better off, say maybe 25%. But if you've allowed something to go down a lot, go back and look at it again. And if the figures don't add up, then just don't hesitate. Just sell it and put it into something that you feel strongly that really is a much better purchase, even if you're down 80, 90%. I know it hurts. But if you feel it still holds merit, like I did with this particular stock, then don't be afraid to go in and buy into weakness. Don't buy strength, but buy weakness. And it's amazing how empowering that feels when you do that.
David, has the conflict between Ukraine and Russia had any impact on the precious metals market?
It very much has in an indirect way. Gold, surprisingly, was not strengthened too much by that. But what's interesting is the palladium situation. And so much of this is up in the air, and neither I or anyone else can predict how it's all going to shake out. But what seems to be happening is there's kind of a deadlock between the U.S. and Russia in terms of what's supposed to take place, and the idea of sanctions and this sort of thing. And it seems to be pushing Russia more into the arms of Eastern powers, China, strengthening their relationship, and the question about whether Europe's going to get all the natural gas that they need from Russia and this type of thing. But in terms of palladium, for what we know, their stockpile has been pretty much exhausted over the last few years at Norilsk. It's going to take years to ramp up the production in that facility, and that's where an awful lot of the world's palladium comes from. And so it's had an unintended effect of creating heightened concern about the PGMs. And I think that's one of the reasons of many, really, that palladium broke out into intermediate highs a week or so ago. And that kind of conforms to what we were discussing before the break here about, if things have become clearer, then you go look at it, and also sometimes you have a chance to get back in. There were people bemoaning the fact that they didn't buy palladium at $700 an ounce or $720, and it went up to almost $800 last week. But before that happened, there were still opportunities over several days to buy it with half of that kind of a rise, around the 750, 760 area, if people had paid attention and perhaps purchased an ETF. Now they've actually come up with two new palladium ETFs. I believe they're both in South Africa. And so this is even more reason to see that more and more of the metal will be taken off the market in anticipation of higher prices. So whereas the palladium market has become a little clearer in terms of the information we need to support higher prices, it's still not so clear that the risk-reward looks really bad and you just don't want to even look at it again, in my view.
And again, you said the two new ETFs are in South Africa, and South Africa still is not a stable market.
No, it's not, but people buying those ETFs will pull more metal off the market because, as you know, when someone buys a share in the ETF is committed to buying that much of the metal and putting it in storage. And so, given the success of the other ETFs that PGM related, I don't see why this will be any different, and I think it will add more to the supply constraints going forward.
So palladium, a hot player right now, and with the demand for it likely to stay that way. Of course, we don't like to look too much into the future, but it is something that people are paying a lot of attention to right now.
It is, and if you, if you try to buy it in weakness and you buy it in tranches, like we've always discussed about the mining stocks, and there are a couple good mining stock plays on palladium too and platinum, then you'll sleep better at night rather than if you decide, I've got to get in, and you buy it all right in here. That's always that's a recipe for heartburn.
Right. I think once you talked with a gentleman who decided he was going to go all in on some particular investment because he'd heard a lot about it over the last few weeks, and just as he put all of his money in, it dropped.
It's actually happened several times, and the most notable case that I remember happened just a couple days before silver topped around $48 in 2011. This person took money that he just felt he had to try to make a fair amount of money, and he took vacation money that he was going to use for the next couple of years for his family, and just put it all into he bought physical silver, and it was real sad. I talked to him the day after he did it, and I looked at the charts and I thought, boy, this guy's accepting a lot of risk, and I didn't have the heart to tell him that it was really a sad thing for him to do. And of course, I had no idea that prices would drop as far as they did, but he lost about 60% of his investment by doing that, and then maybe he's still holding on, but I'm sure he's unhappy, and the odds are very good that he sold someplace down in here for a very large loss. So those things are always very sad, but if we don't go against our emotions, then that's what happens to us.
You bought the ship, but all you got was the anchor.
That's it. And I'll tell you, in the past I've done things like that, and I've tried to leave that history way behind, but it's something that we have to struggle with every time we're in the market, and no one really gets away from it entirely. We just have to control the fear and the greed. Thanks
a lot for chatting with us, David.
You bet, Jim. It's been great speaking with you today.
My guest has been David Smith, Senior Analyst for the Morgan Report, which you can find online at silver-investor.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Comments can be sent to info@HowStreet.com. I'm Jim Goddard.